Happy Independence Day. America turns 250 today. The market is dark for the long weekend, and that is exactly why this is the brief to hear. Because three things are compounding in the quiet, and the loudest one is not a price. When the exchanges reopen Monday, they reopen into a record-high Dow sitting right on top of a chip complex that just had its worst 2 days in months. That contradiction is the whole story. Here is your full picture in about 5 minutes. First, the board frozen at Thursday's close. The Dow 52,900 up 1.14%, an all-time high. The S&P 7,483 dead flat, torn between the two tapes. The Nasdaq down 0.8% on a brutal chip sell-off. Gold around 4,120 an ounce, bouncing off an 8-month low. Bitcoin firm near 61,800, up 2.5% on the week. Oil $69, calm, back at pre-conflict levels, and the 10-year eased to 4.48 as rate hike odds fade. One word for this tape: divided. Now the reads, where we part ways with the crowd. Read 1. Everyone sees the all-time high and says the bull market is intact. Here is the tell. The Dow set that record on the very same day the Nasdaq fell and the S&P closed flat. The record lives in 30 industrial stocks. The growth names and the chips got sold. A high that only the narrowest index in the market can confirm is not a breakout. It is a rotation wearing a breakout's clothes. Believe the breadth, not the banner. Follow the money, and it all traces back to one number. June payrolls, 57,000 jobs against about 115,000 expected. The weakest in 4 months, with the 2 prior months revised down. Unemployment ticked to 4.2%, but that was flattered because people left the workforce, not because they found jobs. The market cheered anyway, because a cooling labor market pins the Federal Reserve. But labor is now cooling faster than inflation is falling. That is a yellow flag dressed up as good news. And zoom out on the Federal Reserve, because the rate story is really an oil story. The whole hawkish turn began with February's energy shock. Now the Strait of Hormuz is normalizing as talks with Iran progress, and crude is back near $69, right where it traded before the conflict. The inflation premise behind higher for longer is evaporating in real time. Gold sees it, that is the rebound bid. The dollar sees it, it is softening. The bond market sees it. The last one to admit it, as always, will be the rate path itself. Read 2. The market keeps treating chips and the artificial intelligence trade as the same thing. They have quietly split. On the very week the Nasdaq dumped the graphics processor names as one basket, Micron crossed a $1 trillion market value for the first time ever on an artificial intelligence memory supercycle. Its high-bandwidth memory for this year is already sold out, and one major bank just tripled its price target to $1,625. The trade did not die, it moved, from the chips that do the computing to the memory that feeds them. Now the sentiment check from our market and social sentiment monitoring. The finance commentary world is almost unanimously cautious right now. Sell the artificial intelligence trade, rotate to gold, brace for a bubble that is supposedly months away. Meanwhile, crypto-native positioning is the most bullish it has been in years, precisely because everyone else is short, jaded, or sidelined. 2 camps, maximum conviction, pointed in exactly opposite directions. When it looks like this, somebody is about to be very wrong, and that gap is where the edge lies. The tell of the weekend, and it is not a stock price, 49 gigawatts. That is the estimated gap by 2028 between the power the artificial intelligence build-out will demand, about 74 gigawatts, and what the electrical grid can actually deliver. 49 gigawatts of shortfall is on the order of a mid-sized country's entire electricity supply. The market spent Thursday arguing about whether the spending is justified. The number that actually decides the build-out is not a dollar figure at all. It is a megawatt figure, and it is already short. Frankie has the full breakdown in today's focus, linked below. Sectors in play. In the chips, the sort that matters is content versus capacity. Memory, testing, inspection, the content that grows as chips get harder to build, is a completely different business from renting out commodity computing, which is where any glut lands first. In metals, gold's bid is real, but gold over technology is now the crowded hedge, and a crowded hedge is a compressed edge. And in crypto, the structural story keeps building under a weak tape. Germany's savings banks rolling out retail crypto, Bhutan moving more Bitcoin, Revolut delisting Tether for 50 million users. Rails being laid, whatever the tokens do. On the radar into Monday's reopen. First, the reopen itself, the first reaction to the jobs miss and the dovish repricing. Does the 10-year hold, does the melt-up continue, or does the thin breadth finally crack? Second, the chips. A bounce or a third straight down day, which tells you whether Thursday was a rotation or a top. Then Micron and the memory momentum. Do peers follow, or does the trillion-dollar milestone mark a local top? And later this month, the June inflation print and the cloud giants' capital spending guides. Do they still spend into a sell-off, and can the grid take it if they do? And the scorecard, because we put our calls on the record, dated and falsifiable. 3 today. 1. The record Dow is a rotation artifact, not a broad breakout, and it reframes as a growth scare within 2 quarters. We are wrong if payrolls re-accelerate and breadth reclaims leadership. 2. The binding constraint on the artificial intelligence build-out through 2027 is power and grid delivery, not chips or capital. We are wrong if those bottlenecks clear on their own. 3. The marginal winner has moved from graphics processors to memory and physical infrastructure. We are wrong if memory pricing rolls over. All 3 go in the ledger. So the bottom line, for 2 years, the artificial intelligence trade has been a story about money. Who is spending it, who is making it, whether the returns justify it. But money was never the scarce input. Electrons are. If the thing that ultimately caps the biggest capital cycle of our lifetimes turns out to be a transformer backlog and a 3-year wait to plug into the grid, then the most important companies of the next decade might not be the ones that design the intelligence. They will be the ones that power it. Sit with that one this weekend. That is the brief. The full written breakdown and today's focus with Frankie are both linked below. I'm Earl. This is the asymmetric signal, one contrarian read a day. Subscribe.